This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Partners Investment Perspectives. President Trump's executive orders are in full swing, with changes to tariffs announced almost on a daily basis. This has created a lot of uncertainty, which is something markets don't like. And US exceptionalism is now being questioned. After a strong start to the year, equities, both domestic and global, are now down, with the best performers from last year leading the move lower. Australian banks and US tech stocks have dropped more than 10% since mid-Feb. So, to discuss what all this means for policy, economic growth and markets is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Tracey, it's been easy to get stuck in the weeds over the past 57 days since President Trump's inauguration. So let's take a helicopter view and talk about US exceptionalism. For decades, the US has been the dominant force in global politics, economics, and military power. But today, we're seeing cracks in that dominance. How do you see this playing out?
Well, thanks, Ed. It seems strange, just 57 days. It feels like it's been a lot longer than that. I think the notion of American exceptionalism that investors have largely accepted over the past 150 to 200 years is now under threat. The idea that America is the global leader and defender of people, property, and global institutions is being fundamentally challenged. And I think there's a couple of points to note here. The first one is one that we've known for a while. Economic power is shifting. The US share of global GDP has declined from around 50% after World War II to less than 25% today. China is rising as an economic superpower, and countries like India, Brazil, and Indonesia are asserting themselves. A more recent trend is around defense. The new US administration is questioning whether they want to continue to be the primary provider of global defense. It's an expensive exercise. It has 700 overseas military bases in over 80 countries. And so for an administration that is focused on the budget, you can understand why this is in their sights. And so now more countries are hedging their bets rather than relying on US protection.
Interesting. And politically, are we seeing a decline in soft power?
I think absolutely. The US model of democracy is being questioned, not just abroad, but domestically. The January 6th insurrection, increasing political polarization, and challenges to voting rights all raise doubts about the stability of American governance. And meanwhile, countries like China are promoting their own authoritarian capitalist model as an alternative. And then there's the dollar's diminishing dominance. While it is still the world's reserve currency, that's clear, there are serious efforts to de-dollarize trade with countries like China, Russia, and even Saudi Arabia shifting towards alternative currencies like the yuan.
So, Tracey, does this mean the US has reached peak superpower status?
The US still has enormous influence, the strongest military and an unmatched tech sector, but we're witnessing a multipolar world where the US is one of now several major powers rather than the uncontested leader. And I think that's the real shift that we're seeing.
What does this multipolar world look like?
Well, so it's a multipolar world is just that. It's a world where power is distributed among multiple global actors rather than being concentrated in a single superpower like the US. If we think about it as four major power centers, so we have the US, China, Europe, and emerging South. So the US and its Western allies, so this would include institutions and organisations like NATO and G7, Five Eyes, AUKUS, they still dominate in finance, military technology, and soft power. They control the world's reserve currency, the US dollar, but they are now facing internal divisions. President Trump has threatened both to annex Canada and to eject it from the Five Eyes Spy Act. They're also facing declining economic dominance and political instability. Putin arguably has been central in driving those divisions. It's to his benefit. And then there's China, the world's second largest economy, projected to overtake the US in GDP terms within the next decade. It is expanding its influence through Belt and Road initiative, through trade dominance and military buildup. It is flexing its muscle militarily. We're seeing that here in Australia. Financially, it is developing parallel financial institutions like the BRICS Bank, like the Asian Infrastructure Investment Bank, and the digital yuan. So China is challenging the US-led world order by forging ties with countries like Russia, Iran, and Africa. You can see this in its sell down of its holdings of US treasuries. It's cut its holdings of US treasuries by about half in the past couple of years. And then the EU, a major economic and regulatory superpower with the ability to set global standards, it struggles with internal political fragmentation. We've seen this in the past with Brexit, nationalistic movements, energy dependence on Russia. It wants strategic autonomy, but still depends on the US for defense, but that is changing, but it will take time. You can't just quickly build up your military. It's going to take time. And they do rely on the US for a lot of that. And then finally, the emerging global south. This is a group that would include countries like India and Brazil and South Africa and Middle East and the ASEAN countries in Africa. This group is pursuing more independent foreign policies based on national interests. India is a rising military and tech power. It has the fourth largest military in the world. Increasingly, it is assertive under Modi. The Middle East is diversifying alliances. Saudi Arabia is now working with China and Russia on energy deals. And then Africa is playing quite an important role in resource trade. So I think these are the main parties in this multipolar world, Ed.
Okay, Tracey, so we have these competing power centers. What does that mean for global stability and for investors in general?
Well, it means that the world is going to be more unpredictable and we're going to be more competitive with each other. There will be less cooperation. We described it in our annual agenda publication as a more introverted world where trust between allies is tested. This means more regional conflicts and shifting alliances. In a US-led unipolar world, conflicts were kept under control by American military dominance. In a multipolar world, there are multiple centers of power backing different sides in conflicts. We're already seeing this with Russia in Ukraine, China in Taiwan, and the regional disputes in the Middle East and Africa. So we're seeing the end of a single rules-based order. Since World War II, the US has dictated the global norms: free trade, the promotion of democracy, military deterrence and disarmament. Now China is promoting authoritarian capitalism as an alternative. India, the Middle East, and Africa are choosing pragmatic policies, doing business with the US, but also with China and Russia, rather than picking sides. We are seeing fragmentation and growing distrust of global institutions. The United Nations, World Trade Organization, International Monetary Fund, and the World Bank are being challenged by BRICS and the Asian Infrastructure Bank and alternative regional alliances, and the G7 is less relevant today. For investors, as we noted in the publication, all of this amounts to what really is a riskier world, and it's also a more expensive world. Inflation and interest rates will be higher. And so for investors, defensive sectors like healthcare and consumer staples and utilities will likely perform better than cyclicals or interest rate sensitive sectors like IT, consumer discretionary and communication services. The equity markets where these defensive sectors are relatively high is mostly in Europe, actually.
So, Tracey, what's your biggest takeaway about the multipolar world we're entering?
Well, the old world order, where the US calls the shots and the rest of the world follows, is rapidly aging. It's not helped by its own US politics. Instead, we're entering a competitive, decentralized era where no single power is in control. This is both a challenge and an opportunity. Countries, businesses, and investors will have to navigate a much more fragmented, volatile global system. For an investor, it means the opportunity set to invest in different markets has increased. So countries are going their own way in this new world, and that opens up the whole investment opportunity set for investors.
It's truly fascinating. The shift from a unipolar to a multipolar world is one of the biggest geopolitical changes of our time, and it's happening faster than most people realize. Tracey, that brings us to NATO, the alliance that defined the Cold War and kept the West united for so long through so many challenging times. Could we really be seeing its end? Gerard Minack, our independent investment committee member, said it's not dead yet, but it's on life support.
Yes, I think, and for several reasons. Europe's trust in the US is eroding. During the first Trump administration, he called NATO obsolete. Many European leaders are therefore rightly worried about America's reliability. And second, the Ukraine war has exposed NATO's limits. Yes, the alliance has been vital in supporting Ukraine, but it has also shown how dependent Europe is on US military aid. That's unsustainable, as we are now seeing. So countries like France and Germany are now pushing for an independent European defence force.
But Tracey, hasn't NATO expanded recently? Finland and Sweden are joining. Doesn't that strengthen the alliance?
It does in the short term. In the long term, though, it does also stretch NATO's obligations. Expanding into areas that directly antagonize Russia could lead to more divisions within the alliance. And then there's Turkey. As a NATO member, Turkey has blocked Sweden's entry. It has bought Russian military equipment, and it's pursued its own foreign policy. That's a sign that NATO isn't as unified as it seems.
So if NATO were to dissolve or become irrelevant, what would the world look like? What would take its place?
Well, I think we'd potentially see the rise of regional military blocs. Europe might form its own defence pact. Even Switzerland, who is not a NATO member and is historically neutral, is talking more about a defence alliance. That's just very recent. The issue is particularly pressing for Eastern Europe, who are physically closer to Russia. The US could pivot fully to Asia, focusing on countering China, and we'd likely see Russia and China therefore deepen their military cooperation and form a counterbalance, if you like, to the West. And then there is India, as I said, the fourth largest defence spender globally. Ultimately, NATO will either adapt and redefine itself, or it will just become a hollow alliance that exists in name only. We have Fidelity's David Bridges, who is a former CIA agent, coming in for a chat at the end of the month. So you should look out for an invite from your advisor on that one.
All right, let's shift our focus to something that affects not just governments and corporations, but everyday people. the ongoing tariff and trade war. This conflict is now reshaping global supply chains in profound ways. We've seen waves of tariffs, retaliatory measures, and efforts to decouple economies. How is this reshaping global trade, and what does it mean for businesses and consumers?
Well, so tariffs were supposed to protect domestic industries, but they haven't in the past, and they won't this time. Tariffs increase costs for businesses and for consumers. If we think about the imports into the US as being in, say, 4 broad buckets. So if we have consumer goods, that's about a third of total US imports. And then we have capital goods, that's about another third. And then we have intermediate goods, which is about 17%, and then about 10% in raw goods. On consumer goods, China is the biggest country of origin by far. So the higher the tariffs on China, the bigger the direct impact will be for US consumers. Intermediate and raw goods, these are the inputs into production for US companies. Canada is the biggest country of origin there. So this affects the cost base for US companies. These higher costs will either be passed on to consumers or they'll be absorbed into profit margins, meaning lower company earnings. And on capital goods, machinery and the like, it's China, followed closely by Mexico, that are the big contributors to US imports there. A similar impact will happen there for companies in terms of pressuring margins and lowering earnings. Ultimately, one way or the other, the consumer gets hit, either directly or indirectly by higher prices or by company earnings declining, impacting wage and employment growth. US trading partners are retaliating with their own tariffs, redirecting trade flows away from the US. And so this makes it less likely that companies will shift production to the US because even there they won't avoid the retaliatory tariffs.
Okay, so tariffs didn't quite work as planned, but how did they affect global supply chains?
Well, I think massively we're seeing another shock to the global supply chain. COVID reminded the world how reliant it was on China. Trump is reminding it how reliant it is on global trade in general. Supply chains are being redesigned, they're being redirected, and in many cases replicated. Shifting supply chains isn't easy. It takes time to build new factories, to build the port infrastructure, etc. This too is inflationary. So in short, the global trade map is being redrawn. Companies in the meantime are facing high production costs, shortages, and transportation delays, just as they did during COVID. The big difference now is that there is not as much pent-up demand as there was back then. So the inflationary pressure won't be as great, but it will still exist.
Hey, Tracey, with this new reality taking shape, who are the winners and losers?
Well, yeah, great question. Here's how we see it. The losers are consumers, particularly US consumers, which is about 70% of the US economy. Higher prices due to tariffs and supply chain shifts are bad for them. Small and mid-sized companies in the US, they'll struggle to adjust to these massive trade changes. I think also any economy or country that is export-oriented will be impacted, obviously. In particular, this applies to emerging markets. A large part of their economies is trade-related. This includes countries like South Korea, Mexico, obviously, Saudi Arabia, South Africa. They all have high export shares for their economies. The winners, if there are any, would be countries that have the fiscal capacity to offer government subsidies to produce more at home. And aligned with that, I would say also countries that are more domestically oriented. The countries that are already insular, they'll be a relative winner in this.
Thanks, Tracey. That's all we have time for today. I hope everyone enjoyed the update, and we look forward to you joining us in a fortnight. In the meantime, please take care and stay safe. Thank you.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.